And there are other strategies too. It's just for the knowledge, but mainly to apply strategies, we use whatever that we have seen so far. All right. So what? Excuse me. So what other strategies do we have? Let's have a look at it. So this we have already seen, buying call where the loss is limited, profit is unlimited. You make money on rise, not on fall. And exactly opposite is buying put. Synthetic long call, will come to this also. And then sell call we have seen, sell put we have seen, covered call. Okay, this is also an important strategy. I'll come to this covered call. Long combo. This strategy need not be done. That's why I haven't taken it. But for knowledge, just refer here. We are selling put and buying call. What is the meaning of selling put? We are expecting the price to rise. At the same time, we are also buying call. Again, we are expecting the price to rise. So actually, this is not an hedging strategy. It's a combination of option strategy. I do not say any strategy as hedging where there is a scope for unlimited loss. Your one view should be positive, other view should be negative. Then only that combined strategy is called as an hedged strategy. So this is your long combo. For knowledge purpose, you will have to note it down. Quickly note down this one. Only write down till here. You don't have to write all this. Strategy name should be known. Long combo, sell, put, buy, call, and an example. You can just write down this example and this view. Need not write all this. Quickly note it down. Hello? हाँ कपूरी का ठीक अच्छा ठीक है हाँ So whatever that we are seeing in index, we can do it even on stocks. That time when I was preparing, the price of Reliance was approximately 1,000 rupees. So it has almost doubled. All right. So that's your long combo. Then exactly opposite is the short combo. The strategy can give you immense profit, but it can give you unlimited losses in case there is a sudden rise. That's a short combo. So only write the strategy name and the view and the example. That's all. All this anyway, I'm going to provide you through email. All right, so that's your short combo. Okay, so this is your insurance strategy for the short. This also we will discuss. Covered put also will discuss. Okay, let us complete the pending strategies. So continue with the notes. Covered call. This is again one of my favorite strategy. So those whoever is aiming to make approximately 2% per month kind of returns, for them this strategy is very apt. Covered call. So what we do is buy the stock in portfolio or take futures and sell OTM call to reduce the costing price. Good strategy. Big fund managers, mutual funds, and all that, they do this strategy. Example, buy ITC at 350 and sell 360 CE at 7. Okay, so what is going to be the profit loss at these points? You are going to tell me 300, 320, 350, 360, 367, 370, 380. I'll give you 3 minutes of time. This is a very simple calculation, just plus minus, no break-even point needed. For this bit of calculation would be needed, but still simple. So 3 minutes of time, quickly do it. Alright, so let's do it. If you are buying ITC at 350 and the price goes down to 300, you are apparently losing 50 rupees. Here you will be losing 30 rupees. Here we would be neutral, no profit, no loss, because the price remains same. Remember, we are buying this as a portfolio stock. Why do we do this for ITC and ITC kind of stocks? Because the dividend in ITC is very good. How much dividend do we get in ITC? Every year he pays you consistent dividend. And it's a private company. Dividend yield is around 3%, 3.3%. So likewise, even government companies have got excellent dividend, which we have already seen it, right? 360 call expiry. How much profit we make is 10. 367, we make 17 rupees of profit. 20 rupees. 30 rupees. This is how our profit loss would be in the portfolio. But because we are selling a call, first of all, the break-even point, this is going to be 0, and anything below it, we make a maximum profit of the premium. So we are going to gain 7 rupees in each of this. But if there is a sharp rise, we actually lose money. We lose 3 rupees here. Here we lose 13 rupees. So overall, 43 rupees gain. Sorry, minus 43 rupees loss because the price fell down. Minus 23 plus 7 plus 17 plus 17 plus 17 plus 17. So this strategy is actually giving us limited profit only. Covered call is like this only. And there is a scope for unlimited loss. But anyway, this was a portfolio stock. If the price is falling down, we are anyway going to make unlimited loss. But there is some cushion provided of 7 rupees. Like this, every month if you are able to make 7 rupees. One is you get 20 rupees in dividend every year. Then 7 rupees you are making in every month because of selling of call over a period of time in 3-4 years. Your costing would become 0. The net cost for acquiring ITC would become 0. It is like getting a rent. You have a commercial building, but you are not giving it on rent. Will you make money? Yes, we would still make money by the appreciation of the price. But if you give it to any tenant, then you will make dual income, rental income plus price appreciation. That is how even this is. If the price is the same, after 1 month also ITC price is, let's say, trading at 350. Holding the stock, you did not make anything. But doing something with the options, you have made a bit of money, which is like 7%, 2%. You have got a 2% rent on your portfolio stock. In a month, 2% in stock market is an amazing return. Dividend is anyway there. If the price goes to 10 rupees, you make still extra 7. Your gain is 17, not just 10. But yes, if it rises too sharply, then you would have gained 30, but because you did this strategy, you would gain only 17 rupees. Anyway, you're not making loss, you're at least making money. So 17 rupees on 350 is like 4% return. If any stock is giving 4% return, then we can exit that. We'll buy Dabur, we'll buy Hindustan Unilever. We'll buy Bajaj Finance, we'll buy SBI Bank. So many other stocks are there. So if the price suddenly rises, we exit. We'll have to exit that stock and choose some another company and do the same strategy. But when will you exit? When the returns are double over month. We expected 2%, we are getting 4%, then only we will have to exit. And maybe after going here, it will again come back here. Again, we can enter. We can re-enter. So one of my cousin, he has been doing this since more than 7 years, and he has tripled his portfolio. Only through dividends and this call writing, he has tripled his portfolio. Though market only doubled, but he made 3 times in the last 6 7 years. He started with some 22 lakh. Today's portfolio is more than 66 lakh. So to which kind of companies this has to be done? No doubt. Every month on month, you're reducing your cost price by 2%. So in 50 months, almost, your costing would be zero. And if case the price is rising slowly, gradually and all, it's a bonus for you. Price rises by only 10 rupees, you would have actually made 17. Again next month, price rises by 10 rupees, you would have made again 7. So you are getting price appreciation plus 2% extra return. Out of 12 months, at least 4 5 months will be double benefit. So we can do this when we are in the pessimism phase of the market. Because we know that market may not give even 2% return a month. Market is going to be lackluster, rather it can go away 2% per month. So rather than losing 20% in a year, why not I make 20% positive returns in a year by doing this? So for every phase of the market, there is a strategy. Understand this. Like if you look at a sports person, say Sachin Tendulkar, he doesn't play the same way every match. He will have to change his strategy according to the bowler, according to the team, according to the pitch conditions. Then only he will be a great player. Likewise, even here in the market, you should be like a girgit. Change the colors according to the market. Don't go the same way. Market is not the same every day. In every phase, the market action is entirely different. Accordingly, you need to adopt. Then only you'll be able to make that superior income how Warren Buffett, Rakesh Jhunjhunwala has made. They don't, they haven't played in the same way for years and years. They change their strategy according to market condition. So this strategy does really well in the pessimism phase. You can note on this. Alright, now coming to see the same way you have the covered put, but I would never recommend you to short the stocks. That is why I'm not giving you this strategy. For knowledge purpose, you can refer the notes which I'll be giving you. But short, when you do to any stock, risk is unlimited because on the top you have sky. You bought something at 350, it may become only zero. You lose only 350 rupees. But at 350 rupees, if you are selling it, you are going short. That's called a short. Without having any stock, you are selling it. Then it may become 700, it may become 1000, it may become 7000, it may become 10,000. We never know. So that is going to give you unlimited losses. We should never ever short any stock in our life. Remember this. Then who does it? Mutual funds, big fund managers, those who can control the share price. With their 100 crore, they can make the share price 350 to 370. They can make from 350 to 330. They can control the price because they have 100 crore, 1000 crore, 10,000 crore. We cannot control. That is why we shouldn't ever short any stock. Write it down. Even if you are very clear, company is fraud, company is going to coming into huge losses, whatsoever may be the bad news, never short index, never short market. Blind short, I'm saying. You can do it with hedge position. But when I'm going with covered put, it is not hedged. It is going to give you unlimited loss on the upside. So if you feel that a particular price may fall down, we are going to implement a strategy wherein the loss is going to be limited even if the price becomes 10 times, but not the covered put. Right on? Important note. This one we can do covered call because there is some running business value to ITC. 350 may become 150, but it's not going to become zero, right? But 350 on the upside may become 700,000, 2000. That's why selling is very risky. If you want to sell it, do with hedged, not at all covered put, not at all a blind short. It applies for even commodities and everything. I have seen people going bankrupt by shorting stocks. Okay, coming with the next strategies. So long combo, short combo, not recommended because the scope of unlimited loss. This one you already seen, strangle, straddle, bull call spread, bull put spread, bear call spread, bear put spread. Okay, this is important. Kindly take the screenshot of this. This is going to be useful for you for lifelong. Give you 1 minute of time. Please take the screenshot or take a picture from your mobile. I'm anyway giving you all this, but still. So what this means is the color denotes the view. How much dark color, that much strong and big view that you have over the index or the stock. Meaning, if you feel that a particular index stock or any instrument, whether it could be dollar, it could be commodity, whatsoever, even it could be crypto. You have strategies for that as well. If you feel that there will be a big rise, big jump in the price, then you can do either of these three. But if you see that there is going to be a moderate rise, you can implement these two strategies. You feel you are mildly bullish, it may rise but may rise only little bit, sir. Then this one. And so is for bearish. You feel that the price is going to crash badly, then you can implement any of these three strategies. You are mildly bearish, then these two. You are slightly bearish, then this one. And this is for the volatile market. You feel that there is going to be a big wave in the market, but you do not know whether it is going to be on the upside or the downside. Example, let's say elections. Post election results, post budget, market has got a big movement most of the time. But most of the time the premiums are also high. But when you see the premiums are low and you are expecting a movement beyond the premium, beyond the break even points, then you can go with long. Long straddle, which we have already discussed in yesterday's class. But if you know the tide is going to be smaller, market is expecting a big movement but it may not come, market is likely to consolidate, then you can go with short straddle. Alright? And these are all the examples for each of them, whatever that we have discussed so far. So all these things are going to help you to get better grip over the hedging strategies. Need not write all that, but you can take screenshot. So 20 seconds, quickly take the screenshot. Next one. Previous one was strong bullish. This is medium bullish. Next, bearish. Strong bearish. Never ever do such kind of strategies where losses can be unlimited. Slightly bearish. This is volatile and stable market. Okay, so these are all the strategies we have. Apart from this, we also have ratio spreads and calendar spread, which we'll be discussing. Okay, this is what calendar spread and all. Let's understand that. Firstly, the ratio spread. Right on. So ratio spread can be of various types, but what is the meaning of ratio spread? Let us understand that. Very, very important notes for ratio spread. It is also an hedge trade, but you make money only when your view is either totally wrong or totally right. You are just saying that the game is between India, Pakistan, or India, England, or England, Pakistan. Some game is going to go on, and you are saying, I'm not sure which team will win, but it's gonna be a big game. That's how you are betting. It's gonna be a big game. Whether it is Pakistan winning, it will win by a big margin, or whether it is an England winning, England is going to win by a big margin. It's not going to be a tough match. Basically, that's what you are trying to say. Example or strategy one. Let's take Nifty itself. Buy to ATM, buy to ATM, call expiry, put expiry. Buy to ATM, put expiry, and buy futures. Either this is one, or you can do the same thing even with options. Either this can also be done, that can also be done. And then finally you can do even this. This is what I do, the third one. Sell ITM in the money, Okay, so this is the one which I generally like it. So let us see how this strategy runs. Example, Nifty. So ITM put expiry means what? High premium put. So we are taking tomorrow's expiry itself as an example under consideration. We'll take the round figure 18,000 put. We sell it at, sorry, put means you have to go on the higher side in the money shaded area. So 18,600 put we are selling at 170. And buy 18,400 put at 50. Double. Okay, very interesting strategy. Here this is double, this is only single. Huh? Now what would happen at these points? Let's see who can compute. Little complex calculation. 17,500, 17,800, 18,000. 18,400, 18,300. Okay, so you have to calculate for both of these leg. So I'll give you 5 minutes of time. Let's see who can do it. If you are able to do this easily, you have already got the grip over the options, guys. This is into 2, okay, and then total. Always go with the rule. First calculate the break-even point. You can take this value, not necessary, but still take it for easy break-even point for the put option. Second one. Okay, so let's do it. So 18,600 put has been sold at 170, meaning what is the break-even point? It is a put, so minus it. 18,600 minus 170 is 18,430. That's the break-even point. I have sold the put, meaning I would make money when the price is falling, isn't it? So I'll be gaining 70 rupees here, and here I'll be gaining 430. Sorry, this is only 30 rupees. I'll be gaining only 30 rupees. 400, this one, sorry. Yeah, clear? And here I'll be gaining 430 minus 350. So that is your 80 points. Here I'll be gaining 18,600 put weight. Yeah. So 18,300 put. It's other way around, sorry.
Yeah.
Minus.
It's just a minus.
Yeah, sorry. Okay. So we would be making money when the prices, we'll be losing money when the price is actually falling down, because our view is bullish. We are sold put, not buy put. So here I would be losing 130 points. So there is going to be a scope for unlimited loss. Why? Because we are seller of an option. I'll be losing here 430 points. Here I'll be losing 17,800 minus 18,430, 630 points. Here I'll be losing 930 points. Kindly check the values. Here I would be gaining full 170 points. My maximum profit is going to be only the premium, because I am seller of an option. Something I sold at 170, I buy at 0. So I'm going to get the full premium. Hope the first leg is correct. Now the second one. Break even point is 350. How? 18,400 minus 50 premium. Alright. So I am going to make money when the price is falling, but I am going to lose money when the price is rising. But how much would I lose here? 50 points. But into 2. Because I've got 2 lots, so I'm going to lose altogether 100 points here. Everywhere I'll be losing this. Why? Because I am buyer of an option. I would be making loss when the price is rising. Clear? Here I would be gaining money because I am buyer of the put. How much? 50 points I would gain. How? This is the break even point. So break even point minus the expected price of expiry. Here I would be gaining massively. Right? Here or we are getting the same values. Clear? Now what would be my profit loss? Let us compute that. So in total 1700 positive minus 930. So 700 plus 70, that is 770 points of profit. So though you thought that the price may rise, yet you are making money when the price is crashing. 1100 minus 630. 370, 470. 700 minus 430. Minus 130 plus 100. Here we lose money, but only a minor loss. Why is this moving? Here we would be losing 80 points. Okay, because this is neutral, here we lose 80. Minus 30 minus 100, this is what is going to be your maximum loss. This is going to be the maximum loss. You cannot lose more than this in this strike price. Then 430 minus 100. Now again you will come back to profit. This is the magic of this ratio spread. So your view was the market could crash badly. Now let us imagine election. Let us take election into account that next month there is going to be election. So you are framing your strategy now itself, or maybe just 2-3 days before the election. The chances of winning any particular party is 50-50. You do not know what is going to happen. Lot of uncertainty. We may have hung parliament. We may not have clear majority. Or we may have one-sided majority. That can also happen. So you are basically expecting the markets may crash badly because 80% you feel that no party will get a majority, and if that is the case, markets will crash badly. But 20% chances are there. One party may get clear majority and the market may even rise. It may even hit upper circuit. That's why you want to play in both the directions. That's why you have framed this strategy. Basically, you are expecting something big to happen, but not sure which direction, but you are little biased that it can be on the downside. If really your view goes correct, you make huge money. How much it falls, that much lottery ticket you get, that much big reward you would have. But in case you have gone wrong, yet you are making profit. This is the magic of ratio spread. Like I have done it for this leg, I want you to do it for the other two. We have done this part. So kindly do for this one. You'll find same kind of profit loss, but still I want you to do it. This one as well as this one. Choose your own stock or index, whatever that you want. So that is all for today. Options is all about practice. The more you practice, the better strategies you can create. To say there are unlimited strategies in options. I am giving you only the preface of it. Later with your mind you can do your own strategy. Example, you can take 2 put and 3 call. Like this also you can do. It's up to you. Okay. You can do 3-4 ratio. Depending upon the view, you'll have to adjust your position. That's all. You are basically playing chess with the market. And then this position, when we see that okay, no big movement is coming, we are stuck in this particular range, you can still alter the positions. You can increase more sell, you can reduce the buy. Like that, so many things you can do in order to minimize the loss in case you see that neither this is happening nor this is happening. So that art is difficult. For that, you'll have to be really expert in the option gaming. Mind should calculate pretty fast and keep on altering the strategy according to the market condition. Like such, there are 1% people who make enormous income in the options trading. That is all for today. I open the floor for clearing the doubts. Use the chat window or the audio control.